Imagine investing in a company that holds the key to solving a critical U.S. national security vulnerability, all while poised to become a massively profitable gold producer. Sounds like a dream, right?
hmm Almost too good to be true sometimes.
But with that immense potential comes an equally immense set of challenges, making the stock a true battleground for investors. We're about to dive deep into exactly what makes Perpetua Resources one of the most compelling and perhaps most controversial stories in the market today. Welcome to the Deep Dive, where we unpack complex topics using a stack of comprehensive sources, articles, and research. All the insights we're sharing with you today are current as of August 8th, 2025.
That's right.
Our focus: Perpetua Resources, trading as PPTA on NASDAQ, a company sitting squarely at the intersection of America's critical mineral supply chain and the global gold industry.
And our mission today is really to cut through all that noise. We want you to walk away from this deep dive with a crystal clear understanding of the crucial factors driving this unique development stage company. You'll learn to discern the powerful bullish arguments from the significant execution risks, so you can be truly well-informed about this remarkable investment opportunity.
Now, a quick heads up. Perpetua Resources is scheduled to announce its second quarter 2025 financial results after the market closes today, August 8, 2025.
Right.
Later today. For a company like Perpetua, which isn't generating revenue yet, the focus won't really be on the numbers themselves. Instead, we'll be looking for qualitative updates, progress on their financing, their permitting process, any legal developments.
The narrative updates are key for them right now.
Exactly. Stick with us because we will be covering these earnings and the management call minutes after their release. You definitely won't want to miss that critical follow-up deep dive. Before we jump into the core of it, a quick note. If you appreciate this deep dive, you'll love what we're doing at Stock Analytics AI. Our 4.99-month members get priority deep dives on specific tickers. We're covering all of the S&P 500 stocks over the next few months, and members get exclusive priority access to our analysis. Or if you just want a one-off deep dive on a specific stock, you can simply drop us a super paper thing.
Yeah.
Okay, let's unpack this big question. Could a single mine in Idaho truly secure America's critical mineral supply chain and become a highly profitable gold operation?
That's the multi-billion-dollar question, isn't it?
It is. That's the monumental goal Perpetua Resources has set for itself with its Stibnite Gold Project.
Chapter 1. Business Understanding. That's precisely where the story begins. Perpetua Resources is what we call a development stage natural resources company. This is a crucial distinction because it means, for now, they're generating, no revenue.
Zero, right.
Their entire future business model is vertically integrated, from exploration and extraction to processing, and a really important component, significant environmental restoration. Revenue is projected to kick in around 2028, coming from two key products, gold and antimony.
So gold is the obvious one, the big economic driver, right? What makes their gold project stand out?
Exactly. The Stibnite Gold Project is designed to be one of the largest and highest-grade open-pit gold mines in the U.S. They're projecting to recover over 4.2 million ounces of gold over an initial 15-year mine life.
That's a lot of gold.
It's a substantial amount.
Yeah.
But here's where it gets truly fascinating and where that battleground aspect really begins to emerge. Antimony.
Right, the strategic part.
The Stibnite mine is said to be the only domestic U.S. source of mined antimony. And that's not just a number. Antimony is a federally designated critical mineral. It's absolutely vital for national defense think munitions and night vision goggles, as well as aerospace and advanced technology, like next-generation energy storage.
Okay.
Perpetua plans to produce about 115 million pounds of it, a truly strategic quantity.
So once this mine is operational, targeted for 2028, Perpetua wouldn't just be a significant U.S. gold producer, likely top 10.
Actually, yes.
Their position in antimony would be profound. The U.S. currently relies 100% on imports for this critical mineral, with China and Russia controlling most of the global supply.
It's a huge dependency.
Perpetua would become the sole domestic producer, directly addressing a massive supply chain vulnerability. This unique combination gives them what you could call a trifecta value proposition, right? A major part of the bull case. First, the economic value from robust projected economics, high-grade gold, very low costs. Second, the powerful strategic and geopolitical value for securing domestic antimony for defense and clean energy. And perhaps most surprisingly, a significant environmental value, using proceeds from modern mining to fund large-scale cleanup and restoration of a historic brownfield site.
Yeah, cleaning up an old mess,
Yeah.
improving water quality, reconnecting fish passages blocked for decades. It's quite a narrative.
It really is.
It's truly a unique setup.
Mhm.
What's even more compelling is that both gold and antimony are benefiting from powerful long-term market trends. Gold, for instance, is in a strong uptrend, trading above $3,300 per ounce as of August 2025.
Which is up significantly, like 40% year over year.
Roughly, yeah. Driven by geopolitical uncertainty, central bank buying its classic role as an inflation hedge. JP Morgan is even forecasting potentially $4,000 an ounce by mid-2026.
Wow.
Antimony, meanwhile, is undergoing a structural shift of its own. It's projected to grow at a compound annual growth rate of 6.5% to 7.5% through 2032 due to surging demand in flame retardants, batteries, military applications.
And the China situation helps them?
Absolutely. There's also a looming supply crisis due to China's export restrictions, making new non-Chinese sources like Perpetua's exceptionally valuable.
So the market seems to be aligning for them. How do they stack up against the competition in these two very different markets?
Well, for gold, Perpetua competes with other junior and mid-tier producers, but they have distinct advantages. A superior deposit grade, projected low costs, and the stability of being in a U.S. jurisdiction.
Okay.
For antimony, they're almost in a near monopoly position in the U.S. because there are currently no other active domestic antimony mines.
None at all.
Zero. Globally, it's an oligopoly dominated by China, Russia, and Tajikistan, positioning Perpetua as the primary Western solution. The regulatory environment also plays a key role. The project's located in stable Idaho, and they achieved a major federal milestone: the final record of decision from the U.S. Forest Service in early 2025.
After a really long review, right? Like a decade.
Yeah, a rigorous decade-long review. It's even been designated a transparency project by the White House, signaling high-level government support. While some ancillary permits are still required, the main federal hurdle is cleared.
And if we connect this to the bigger picture, you mentioned a moat earlier.
Yep.
What are the barriers to entry that would protect Perpetua's position?
Oh, the barriers here are immense, forming a very deep economic moat around the project. First, there's geological scarcity. Finding this rare combination of high-grade gold and critical antimony in one deposit is incredibly difficult.
This doesn't happen often.
Very rarely.
Mm.
Then there are the prohibitive capital costs, estimated at over $2.2 billion for initial construction. Huge number. And finally, the complex and lengthy permitting process itself. Perpetua has already spent over 10 years and hundreds of millions of dollars just navigating that. A new entrant would literally have to start from scratch.
So what does this all mean for Perpetua's competitive edge? How do they leverage these unique attributes?
Well, their brand strength is built around responsible, modern mining, emphasizing transparency and environmental stewardship by using mining to clean up a legacy mess. This is critical for building what's called social license to operate in today's world.
Makes sense.
On cost advantages, the geology is truly exceptional. They project very low all-in sustaining costs, or AISC, of less than $760 per ounce of gold over the mine life.
Less than $760.
Yeah, and a remarkably low $435 per ounce during the first 4 years of production. At current gold prices, this implies massive potential profit margins, thanks to those high grades and significant antimony byproduct credits offsetting costs.
I can see how those low costs are a huge advantage. What about their strategic relationships or unique assets?
In terms of market pull, they already have an off-take agreement with Ambri, a U.S. battery company, validating the demand for their antimony.
Okay, so there's proven demand.
Yes, but for the U.S. Department of Defense, Perpetua is the only identified domestic source for military-spec antimony trisulfide. That's the precise high-purity form they need for defense applications.
So the DoD needs them.
It creates an insurmountable switching cost for the government and a powerful incentive to see this project succeed. Ultimately, the Stibnite Gold Project itself is a truly unique geological asset, largest known U.S. antimony resource, high-grade gold, Tier 1 mining jurisdiction like Idaho. And here's where that geopolitical moat becomes truly fascinating. U.S. government support, including DoD funding and active consideration for a large sum bank loan, essentially transforms this into strategic national infrastructure.
That's a powerful card to play.
Chapter 2, Management Evaluation, absolutely. And the strength of a development stage company like Perpetua pre-revenue, building such a massive project, rests heavily on its leadership. and this team is experienced.
Tell me about them.
John Cherry, their president and CEO, brings over 33 years of mining experience, including successfully leading PolyMet through a complex U.S. permitting process. He also spent 20 years at Rio Tinto, focusing on environmental and government affairs, and is a licensed environmental engineer, highly relevant for Perpetua's restoration-focused mission.
Okay, solid background.
Then Jessica Largent, the CFO, comes from Newmont, the world's largest gold producer, with over 15 years in mining finance. Her expertise is absolutely essential for navigating this multi-billion-dollar financing.
It sounds like they have the right blend of technical and financial expertise. What about the rest of the team or their track record in crisis situations?
Yeah, the broader team includes Michael Wright, VP of Projects, with over 2 decades of global project experience, and board members with deep expertise from Barrick Gold and Idaho Power. Their crisis response history is also notable. They successfully navigated that decade-long, often contentious permitting process to secure the final record of decision.
Which wasn't easy, I imagine.
Not at all. That political support is clear, too, with site visits from high-level officials like the U.S. Secretary of Labor and Idaho's governor. This isn't a team that shies away from complex challenges.
When it comes to transparency, how does Perpetua stack up, especially since this is such a high-stakes public project?
They maintain a pretty high standard of communication transparency. They provide regular updates through press releases, investor presentations, SEC filings, and detailed sustainability reports.
Like that 2024 report.
Exactly. Their 2024 sustainability report highlighted an impressive track record of over 154 months. That's nearly 13 years with no reportable environmental spills and 100% employee integrity training. This commitment to transparency is a cornerstone of their responsible mining brand and aims to build that public trust.
So their strategy is clear, full focus on the Stibnite project. How have they been funding this massive undertaking?
Their capital allocation strategy is singularly focused, de-risking and advancing the Stibnite project. There's no M&A strategy here. It's a pure play. The most significant recent move was a strategic $474 million capital raise in mid-2025.
That was pretty recent.
Very recent. This came from an upsized public offering, meaning they sold more shares to the public than initially planned, and a private placement directly to institutional investors. This was critical, designed specifically to satisfy the equity requirements for the pending $2 billion XM bank debt financing.
Ah, so it was tied to the big loan.
Precisely. And here's a powerful third-party validation. Paulson & Co., their largest shareholder, participated heavily in this private placement, signaling a deep long-term belief in the project.
For a company like this, traditional metrics like return on invested capital, ROIC, aren't applicable yet. So what financial projections are relevant?
Exactly. For a pre-revenue company, historical ROIC is negative because they're spending to build. The focus is entirely on the projected after-tax internal rate of return, or IRR, for the project itself.
And what's that looking like?
At current spot prices, that's projected to be over 27%, a very strong potential return if the project comes to fruition. And no, the company has no dividend or share buyback history, as all available capital is being reinvested into advancing this critical project.
Makes sense at this stage.
Chapter 3. Financial Analysis. Looking at Perpetua's current financial profile, it's typical of a development stage miner. No operating revenue, consistent planned losses as they invest, and a balance sheet that's recently been fortified. Their market capitalization is approximately $1.8 billion.
Still pre-revenue, so profit margins NA.
Correct. Zero revenue, all profit margin metrics NA. Their net loss for 2024 was around $14.5 million, reflecting their pre-production status and planned expenditures. And their free cash flow, or FCF, has been consistently and significantly negative, at approximately negative $36.7 million for the trailing 12 months. Which is entirely expected.
Right, they're building something huge.
Exactly. They're investing heavily in this major project.
So the losses aren't a red flag, but an expected part of the journey. What does their current financial health look like, especially with that recent capital raise?
Precisely. Consistent net losses are entirely expected. What's interesting is that the decrease in their 2024 loss was actually due to about $37.4 million in grant income from the Department of Defense.
Ah, that DoD funding again, non-dilutive.
Exactly. Non-dilutive funding, a crucial financial benefit, another sign of government support. Their debt-to-equity ratio is currently 0.000, meaning they're essentially debt-free right now.
For now.
For now, yes. That will change dramatically if the Exim loan is secured. And their current ratio is very strong at nearly 6, indicating robust liquidity and a significant cash buffer from that recent $474 million equity financing.
Valuing a pre-revenue single-asset mining company sounds tricky. How do analysts approach this when traditional metrics like price to earnings aren't useful?
It definitely requires a different approach. Standard metrics like PE are simply not applicable. The standard industry method is discounted cash flow, or DCF, analysis.
So projecting future cash.
Basically, yes. It projects all the future cash flows of the Stibnite Gold Project over its 15-year mine life, modeling the 4.2 million ounces of gold and 115 million pounds of antimony production. The initial capital expenditure is estimated at about $2.2 billion, and their all-in sustaining cost is projected to be less than $760 per ounce of gold.
And how sensitive is that valuation to key assumptions like commodity prices? That seems critical.
Oh, extremely sensitive. The model's output is highly sensitive to both commodity prices and the discount rate applied. Our educational DCF model, using a base case of $3,300 per ounce for gold and a conservative $10 per pound for antimony, with an 8% discount rate reflecting the remaining project risks, suggests an intrinsic value around $21.50 per share.
Okay, $21.50 base case, but sensitive.
Very. The sensitivity analysis is key here. If gold were to drop to $2,800, that could bring the intrinsic value down to maybe $14, while if it soared to $3,800, it could reach $38.50 or even higher.
Huge range.
It is. The current share price of $17.30 suggests the market is pricing in a scenario somewhat below that base case, acknowledging both the significant potential and the substantial execution risks that define this battleground stock.
Chapter 4, Market Sentiment. So given all this, what's the general market perception of Perpetua Resources? You mentioned the analysts.
Yeah, Wall Street analyst sentiment is overwhelmingly positive. We're seeing a strong buy or buy consensus from 5 to 6 analysts with 0 hold or sell ratings.
0 sells. Interesting.
Right. The average 12-month target is around $21.70, implying significant upside from the current $17.30 share price. News flow throughout 2025 has also been exceptionally positive. The successful $474 million financing, their formal $2 billion XM loan application, those supportive site visits, it's all built a bullish narrative.
That sounds fantastic, almost too good to be true. If the analyst sentiment is so bullish, why is there such a fascinating barbell of market sentiment, as you put it? What are the bears seeing?
That's the true puzzle, isn't it? And it speaks directly to the battleground nature of this stock. Short interest in Perpetua is notably high.
How high?
About 13.4% of the public float, or nearly 10 million shares sold short. This indicates a significant portion of the market is actively betting on a decline.
So what are they worried about?
They're focusing intensely on the remaining execution risks. Potential legal delays, the uncertainty around securing that massive XM loan, and just the sheer complexity of building a multi-billion-dollar mine on time and on budget.
Makes sense. Big hurdle still.
Exactly. Despite that, the stock price of $17.30 is trading above both its 50-day simple moving average of $14.73 and its 200-day simple moving average of $12.68. This signals strong short to medium and long-term positive momentum, supported by an impressive 52-week gain of over 145%.
So a real tug-of-war playing out. Bulls versus bears, clear as day.
Absolutely.
Chapter 5, Ownership Structure. Shifting gears, let's talk about who owns Perpetua Resources. For a company like this, institutional ownership can be a real vote of confidence, right?
Absolutely. And Perpetua has a strong institutional shareholder base. Roughly 249 institutions hold about 54% of the shares.
So over half. Any big name?
Key names include Paulson & Co., their largest shareholder, along with Sprott Inc., BlackRock, and Van Eck, the latter likely due to its inclusion in the GDXJ Junior Miners ETF.
Okay, so knowledgeable players.
It indicates the stock is held by strong hands, knowledgeable, long-term investors who understand the development cycle of these kinds of mining projects.
You mentioned Paulson & Co. as the largest shareholder. What's their stake, and what does that mean for the company?
Paulson Co. is by far the most significant insider, holding approximately 31% of the shares.
Wow, nearly a third.
Yeah, it gives them a massive vested interest and significant influence over the company's direction. Recent insider transactions also tell a powerful story. While the number of insider buys and sells is numerically close, the volume is overwhelmingly skewed towards buying around 7.8 million shares bought versus only about 191,000 sold.
Mostly buying then.
And Paulson & Co.'s strategic $100 million purchase of roughly 7.6 million shares in that June 2025 private placement was a very powerful signal of their deep, long-term belief in the project and their desire to maintain their influential stake.
Big validation from the biggest owner.
It's a strong third-party validation for other investors, definitely.
So this high ownership concentration with Paulson holding nearly a third of the shares could be a double-edged sword, gives them a lot of power. But in this case, it sounds like their objective to see the project successfully built is fully aligned with the interests of all shareholders.
That appears to be the case here, yes. Their success is tied directly to the project's success.
Chapter 6, Risk Assessment.
Right. Okay, to truly understand Perpetua, we need a structured look at its risks and opportunities. Let's frame this with a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Good idea. Let's start with strengths.
For strengths, they possess a world-class asset with high-grade, low-cost gold, and that strategic benefit of being the sole U.S. domestic source of antimony, giving them a geopolitical moat. They have an experienced leadership team, strong liquidity from recent financing, and a compelling ESG narrative centered on restoration mining.
Okay, so strong foundation. What about the flip side, their weaknesses?
Their primary weakness is single asset dependency. Their entire fate is tied to the success of the Stibnite project. If something goes wrong there,
Everything goes wrong.
pretty much. They're also pre-revenue, meaning they remain dependent on capital markets for funding, and they do have a history of shareholder dilution to fund the project to this point.
Right, that funding risk. And the opportunities, what could really accelerate their success?
Well, strong commodity markets for both gold and antimony offer significant upside. There's the potential for substantial government funding and support, particularly that crucial EGXM loan. Geopolitical tailwinds like U.S.-China tensions and China's export restrictions on critical minerals further enhance their strategic value.
Makes them more important.
Exactly. And, as we discussed, their positive ESG narrative can attract a broader investor base focused on responsible investment.
Finally, what are the threats that could derail this project? This is where the battleground truly comes to life.
The threats are significant and are precisely what the short sellers are focused on. These include ongoing permitting and legal challenges, even after the final record of decision, which could cause delays.
Lawsuits and things like that.
Yes, potentially.
Hmm.
Financing risk is paramount, as the EXIM loan is not guaranteed, and alternative funding could be more expensive or dilutive. Then there's significant construction and execution risk potential for cost overruns, delays, which are common in projects of this scale.
Happens all the time with big builds.
All the time. And of course, commodity price volatility could always impact the project's long-term viability if prices tank.
How do broader macroeconomic factors like inflation or interest rates fit into this picture?
Inflation presents a dual-edged risk. It certainly threatens the $2.2 billion capital expenditure and ongoing operating costs, potentially leading to overruns.
Makes everything more expensive.
Right. However, the very forces driving inflation, such as currency debasement and geopolitical instability, often drive up gold prices, as gold acts as a classic inflation hedge. So the key question is whether their output prices rise faster than their input costs.
A balancing act. What about interest rates?
Higher interest rates also increase the cost of capital for that massive debt financing and can lower the project's net present value in valuation models, making it look less attractive on paper.
And what about geopolitical factors beyond the U.S.-China dynamic? For example, the U.S. tariffs implemented in 2025. How did that affect things?
Interestingly, the U.S. imposed tariffs of 2025 are actually a net positive for Perpetua. Antimony, along with other critical minerals, was explicitly exempted from new U.S. tariffs.
Oh, okay. So they were protected.
Exactly. This clearly signals a government strategy to bolster domestic supply chains, directly reinforcing the Stibnite project's strategic value. So, the primary geopolitical risk here is not U.S. tariffs, but rather China's export restrictions on antimony, which fundamentally increase the scarcity value of non-Chinese antimony and make Perpetua's Stibnite project even more vital to Western end users.
Makes their position even stronger, potentially.
Potentially, yes.
Chapter 7, Conclusion. Okay, so our deep dive into Perpetua Resources reveals a company at a pivotal inflection point. It presents a starkly defined, high-stakes investment case with powerful arguments for both bulls and bears.
That sums it up well. The bull case rests on several core pillars. It's a superior, world-class asset with robust economics and exceptionally low projected costs. It benefits from powerful geopolitical tailwinds as the sole U.S. antimony source.
Plus, it's de-risked to some extent.
Right. The project is significantly de-risked with the final record of decision, an experienced management team, and substantial equity already raised. And it offers that compelling ESG narrative through its unique, restoration mining model.
But the bear case, as we've discussed, is equally clear and forms that other side of the battleground. There are still ongoing legal and permitting hurdles that could cause delays.
Still risks there.
The up to $2 billion IGAZM loan is not guaranteed, creating significant financing uncertainty. Then there's the substantial construction and execution risk cost overruns, delays typical of mega projects.
Big build, big risks.
And finally, the project's ultimate viability is always subject to commodity price volatility for both gold and antimony.
Always a factor in mining. So what does this all mean for valuation? Our educational DCF model, with that base case intrinsic value around $21.50 per share.
Well, it clearly shows the project's immense potential.
But it's highly sensitive, extremely, with a plausible range from maybe $11 to $38.50 per share, depending on those key assumptions about prices and costs. The current share price of $17.30 reflects the market pricing in both the immense potential and the substantial execution risks that remain.
So, for you, the listener, Perpetua Resources is really a speculative, high-risk, high-reward proposition. It's not a traditional conservative value investment. It's more akin to a venture capital-style investment in a single, potentially transformative asset.
Well put.
The ultimate success here hinges entirely on management's ability to navigate the final critical hurdles of securing full financing and successfully constructing one of America's most important new mines.
And as you consider Perpetual Resources, maybe ask yourself this. In an increasingly unstable world, what is the true non-monetary value of national supply chain security, and how much are markets willing to pay for that peace of mind?
That's a great question to ponder. And that's all for this deep dive. If you found this valuable, please like and subscribe to the Stock Analytics AI YouTube channel.
Hopes is up.
Remember, our members get priority deep dives on tickers, and we're covering all of the S&P 500 stocks over the next few months. You definitely won't want to miss our follow-up on Perpetua's earnings, which are out later today.
And just a final reminder, this analysis was generated by an AI system for educational purposes only and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.